Pull a $20 bill from your wallet and ask yourself what genuinely gives that piece of paper its value. For most of human history, the answer was a tangible commodity, usually a precious metal sitting securely in a heavily guarded vault. Today, that same bill is backed by nothing more than government decree and the collective trust of the global economy. According to data from the Bureau of Labor Statistics, a single dollar from 1971 has lost over 80% of its purchasing power today. This staggering decline is not an accident of history, but the direct result of a fundamental transformation in how the world defines wealth. To understand this seismic shift, we must first define fiat money, a term derived from the Latin phrase meaning "let it be done." Fiat currency has no intrinsic value and is not backed by physical reserves of commodities. Instead, its worth is entirely dependent on the stability of the issuing government and the faith of the people exchanging it. This modern system stands in stark contrast to the historical gold standard, where every unit of currency issued was directly convertible to a specific, fixed amount of gold. Under that old regime, money was simply a convenient, lightweight receipt for a physical asset. The global economy operated under various forms of this commodity-backed system for centuries, culminating in the Bretton Woods Agreement after World War II. Under the Bretton Woods architecture, international currencies were pegged to the United States dollar, and the dollar itself was tethered to gold at a fixed rate of $35 per ounce. This rigid framework constrained how much new money governments could print, effectively anchoring the global financial system to a finite physical resource. It offered immense price stability across borders, but it also severely limited economic flexibility during times of crisis. The breaking point arrived in the summer of 1971, driven by mounting international debts and domestic inflation. As foreign nations began aggressively demanding physical gold in exchange for their mounting reserves of United States dollars, the American gold supply dwindled to critically low levels. On August 15th, President Richard Nixon appeared on national television to announce a temporary suspension of the dollar's convertibility into gold. This unprecedented executive action, which quickly became permanent, is now known as the Nixon Shock. The immediate aftermath of that televised address sent shockwaves through international markets and permanently altered global trade. By severing the final link between the dollar and precious metals, the Nixon Shock effectively terminated the Bretton Woods system and plunged the world into an era of floating exchange rates. Currencies suddenly traded against one another based on market forces, government stability, and relative economic strength, rather than a fixed metallic anchor. The entire concept of money had been irrevocably abstracted from the physical world. This abstraction granted central banks extraordinary new capabilities that reshaped global finance. Without the constraints of physical gold reserves, institutions like the Federal Reserve gained the power to manage monetary policy with unprecedented flexibility. They could now expand or contract the money supply and manipulate interest rates to stimulate economic growth during recessions or cool down overheated markets. This newly acquired agility allowed governments to cushion the blow of financial crises in ways that were mathematically impossible under a rigid commodity peg. However, this immense institutional power introduced an entirely new set of risks to the everyday consumer. The primary danger of an elastic money supply is inflation, which occurs when the creation of new currency outpaces the actual growth of goods and services in the broader economy. When central banks inject trillions of newly created dollars into the financial system, the relative value of every existing dollar naturally decreases. It is a silent, almost imperceptible force that constantly drains the real value of stagnant capital over decades. This dynamic leads directly to currency devaluation, a phenomenon where your money buys progressively less over time. If your salary remains flat while the supply of money expands, your standard of living inevitably declines, even if your bank balance looks identical on paper. For the average wage earner, this creates a hidden treadmill effect within their personal finances. You have to run faster, earning more nominal dollars each year, simply to maintain the exact same purchasing power you held a decade prior. The transition to a fiat system fundamentally altered the mechanics of personal savings. During the era of commodity-backed money, hoarding physical cash in a mattress or a low-yield savings account was a relatively safe, albeit conservative, method of preserving wealth. Today, holding large portions of your net worth in uninvested cash is a mathematically guaranteed strategy for long-term purchasing power destruction. In a world where money is designed to lose value slowly, the concept of a safe haven has been completely redefined. This reality forces a profound psychological shift for anyone looking to build lasting prosperity. You can no longer afford to be merely a passive saver. The mechanics of modern money demand that you become an active investor. To protect the fruits of your labor from the relentless erosion of the printing press, your capital must be deployed into vehicles that have the potential to grow faster than the rate of currency expansion. The rules of the game changed in 1971, and financial survival now requires playing offense. Navigating this landscape requires a sophisticated approach to asset allocation, which is the practice of dividing your investment portfolio among different asset categories like stocks, bonds, and real estate. In a fiat regime, the primary goal of asset allocation is not just to generate absolute returns, but to generate real returns that outpace inflation over the long haul. By carefully distributing capital across various economic sectors, investors can build a fortress around their purchasing power, ensuring that their wealth grows in actual economic weight, not just in nominal numbers. A critical component of this protective strategy is diversification, the risk management technique that mixes a wide variety of investments within a single portfolio. Because central bank policies can impact different asset classes in unpredictable ways, spreading your capital reduces the risk of catastrophic loss from any single economic event. If aggressive monetary expansion negatively impacts the bond market, a well-diversified portfolio might offset those losses through gains in equities or commodities, smoothing out the journey toward long-term financial goals. Academic research consistently underscores the necessity of this approach in modern markets. According to long-term studies published by the National Bureau of Economic Research, holding diversified portfolios of productive assets has historically been the most reliable method for preserving wealth across different inflationary environments. Researchers note that while fiat currencies trend toward depreciation over multi-decade horizons, human ingenuity and corporate productivity tend to trend upward, providing a natural counterbalance to monetary dilution. This academic consensus is reflected in the massive historical migration of capital into hard assets over the last 50 years. Real estate, for example, has become a primary vehicle for wealth preservation precisely because it represents a finite, tangible resource that cannot be printed by a central bank. When the money supply expands, the nominal price of land and physical property naturally adjusts upward to reflect the diluted currency. In many ways, premium real estate has assumed the wealth-storing role that physical gold occupied prior to the Nixon administration. Equities serve a similar protective function, transforming abstract fiat currency into ownership of real, cash-generating businesses. When inflation drives up the cost of raw materials and labor, companies with strong market positions simply pass those increased costs on to consumers through higher prices. This pricing power allows corporate earnings, and by extension stock prices, to float upward on the rising tide of inflation. Owning shares in profitable enterprises effectively aligns your wealth with the very macroeconomic forces driving the cost of living higher. It is crucial, however, to avoid romanticizing the past and assuming the old system was flawless. A common financial myth suggests that returning to a rigid gold standard would solve all modern economic woes by permanently eliminating inflation. In reality, commodity-backed systems frequently triggered severe deflationary spirals, where the money supply could not expand to meet the needs of a growing population or respond to sudden banking panics. Those historical periods were often marked by brutal, prolonged depressions and massive unemployment that modern central banking was specifically designed to prevent. The flexibility of unbacked currency, despite its inflationary tendencies, has facilitated an era of unprecedented global economic expansion. By allowing credit to flow more freely and detaching economic growth from the physical constraints of mining operations, the modern financial architecture has lifted billions out of poverty and funded massive technological innovations. For the astute investor, this credit-driven expansion creates continuous opportunities to participate in wealth creation that simply did not exist in a rigidly constrained metallic economy. Yet this system also exacerbates the modern wealth gap, creating a stark divide between asset owners and wage earners. When central banks implement expansionary monetary policies, the newly created liquidity tends to flow directly into financial markets, driving up the prices of stocks, bonds, and real estate. Those who already own these assets see their net worth multiply rapidly, while those who rely solely on hourly wages or fixed salaries watch their ability to acquire those same assets slip further out of reach. Bridging this gap requires harnessing the mathematical phenomenon of compound interest, which is the process where the returns on your investments begin generating their own returns over time. In a fiat environment, compounding is not merely a wealth-building tool. It is your primary defense mechanism against the silent theft of inflation. By consistently reinvesting dividends and capital gains, you create an exponential growth curve that can outpace the linear degradation of your currency's purchasing power. Ignoring these mechanics poses a severe threat to long-term retirement planning and generational wealth transfer. Consider a professional who meticulously saves $1 million over a 30-year career, but leaves it parked in low-yield cash equivalents out of a desire for absolute safety. If inflation averages just 3% annually, the real purchasing power of that $1 million will be cut in half over 2 decades of retirement. The pursuit of nominal safety in a fiat system often results in the guarantee of absolute risk. Protecting your future requires structuring a portfolio that explicitly acknowledges this reality. This means prioritizing productive assets that generate cash flow, such as dividend-paying stocks or rental properties, over static assets that simply sit idle in a depository account. It means understanding that volatility in the stock market is the necessary price of admission for long-term growth, while the slow, steady erosion of uninvested cash is a hidden tax on financial timidity. Your portfolio must be as dynamic as the monetary policy that surrounds it. Economists frequently refer to this dynamic as the inflation tax, a subtle mechanism that allows governments to manage massive sovereign debt burdens without raising explicit income taxes. By allowing the currency to devalue slightly each year, nations can repay their historical debts with future dollars that are worth significantly less than when they were borrowed. While this strategy keeps the gears of global finance turning, it effectively transfers purchasing power from the hands of private savers directly to the balance sheets of massive institutional debtors. As we look toward the horizon, the nature of money continues to evolve at a blistering pace. The rise of decentralized digital assets and the exploration of central bank digital currencies suggest that we are entering another massive transitional phase in financial history. While the medium of exchange may shift from paper bills to cryptographic tokens, the underlying mandate for investors remains exactly the same. You must deeply understand what gives your money value and how easily that value can be diluted by external forces. Understanding why these mechanics matter is the first step toward true financial independence. The end of the gold standard did not break the financial system. It simply rewrote the rulebook for how capital is preserved and multiplied. We live in an economic ecosystem where money is a fluid, elastic tool rather than a rigid physical constant. Acknowledging this reality frees you from the anxiety of trying to save your way to wealth in a currency designed to depreciate, empowering you to become an active participant in global economic growth. Building lasting prosperity today requires vigilance, ongoing education, and the courage to transform your labor into enduring assets. By mastering the principles of asset allocation, embracing the exponential power of compounding, and recognizing the true nature of the currency in your pocket, you can navigate the complexities of modern markets with absolute clarity. The shift to fiat money changed the definition of wealth forever, but for those willing to understand the new mechanics, the opportunity to build and protect financial freedom has never been greater.